walk through an example of using either the average cost, the FIFO, or the LIFO method to figure out our cost of goods sold and our ending inventory. We can always use specific ID. We can always specifically identify exactly which unit we sold, but sometimes that's not practical, and we're allowed to make certain assumptions, like average cost, FIFO, and LIFO. No matter which assumption we're using or which inventory system we're using, it probably helps to think about beginning inventory plus cost of goods purchased gives us cost of goods available for sale. And then we either have ending inventory or cost of goods sold. For example, I have a motorcycle lot. I start the month with 2 motorcycles on my lot. I buy 3 more. That means my total motorcycles available for sale are 5. I look out at the end of the month and there's only 1 left. I must have sold 4 motorcycles. The issue becomes exactly which motorcycles did I sell? And we need to answer that question whether we're using the perpetual inventory system or the periodic inventory system. Remember, in the perpetual inventory system, we perpetually update our inventory. So we're tracking this relationship between cost of goods sold and ending inventory throughout the period. Let's say we sell 1 motorcycle for $15,000. We debit cash for $15,000, credit sales for $15,000. If expenses are debits, the opposite of expenses is revenue. It must increase with credits. And then we're going to debit our new expense account called the cost of the goods that we just sold, which we're going to abbreviate to be cost of goods sold. If we did an income statement at that moment in time, we'd have revenue of $15,000, sales of $15,000, minus our expense of $10,000, cost of goods sold of $10,000. So we'd have gross profit of $5,000. On the other hand, if we're in the periodic system, we make no effort to update cost of goods sold and inventory during the period. We wait until the end of the time, and then we take our beginning inventory plus the cost of goods purchased to give us total cost of goods available for sale. We subtract that ending inventory number, which we just took, and that gives us our cost of goods sold. So at the time of sale, there's just one journal entry under the periodic system, debit cash, credit sales. But whether we're using the periodic system or the perpetual system, we need to know which unit we just sold. We can always use specific ID. We can always use some kind of electronic system to specifically identify which diamond ring we just sold. That kind of makes sense. But what if we sell ball bearings? What if we sell ping pong balls? What if we sell thousands and thousands of these units? Well, maybe a better way to do it is to use one of the allowed assumptions like average cost, FIFO, or LIFO. Let's take a look at this company, Elementary Inc., and their purchases during 2015. Their beginning inventory was 100 units. They purchased 700 more units, so they had 800 units available for sale. You'll notice we're in an era of rising prices, so LIFO, assuming the last units we bought or the first units we sold, should give us a higher cost of goods sold, which should give us less income taxes to pay. LIFO means less taxes. We take an ending inventory, we discover that there's 300 units left. If there were 800 units available for sale, and there are 300 units left, we must have sold 500 units. We could always have had some kind of electronic system to measure which specific units we sold, but if we're selling hundreds of these things, maybe it's easier to use one of the assumptions. Let's start with average cost. If we spent $9,500 to buy 800 units, our cost per unit is $11.875. If we sold 500, how do we know we sold 500? There were 800 available for sale. There were 300 left. We must have sold 500. 500 times that 11.875 per unit means our cost of goods sold is 5937.5. Our total goods available for sale were 9,500. 9,500 minus 5,938 gives us about 3,562.5 or 3,563 if we round up. Let's instead assume we're in the periodic system and we're using FIFO. First in, first out. We took an inventory of the 800 units available for sale. 300 units were left. That means we must have sold 500 units. Well, which units did we sell? This layer got sold. This layer got sold. 100 plus 200 takes care of 300. And this third layer got sold. That's 500 units total. So 1,000 plus 2,200 plus 2,400 means our cost of goods sold 5,600, and our ending inventory is this last layer here of 3,900. First in, first out assumes the first units we bought were the first units we sold. Now let's use LIFO. Last in, first out. It's an abnormal way of doing things, and it creates all kinds of problems, but we like it. In America, we like it because LIFO means less taxes. There are not very many places in the world where you're allowed to use LIFO, but you can use it here in the United States. So last in, first out. How many units did we sell? We had 800 units available for sale. There were 300 units left. We must have sold 500 units. We must have sold this layer of 300 plus this layer of 200. That must be the 500 units that we sold. So our cost of goods sold is this 2,400 plus the 3,900, or 6,300, and the remaining inventory are these two layers here. Last in, first out assumes the last units we bought were the first ones we sold. We decided there were 500 units that we sold, so we assume we sold these two layers, leaving these two layers in ending inventory. And LIFO really is an unnatural assumption. It's abnormal. It really makes life difficult. It's great that it saves us taxes, but for example, now our inventory consists of these 300 units, but they're priced at $10 and $11 a unit. When we replace the units we just sold in inventory, we're going to build layers and layers above those low priced layers. And as we sell off those higher priced layers, those lower priced layers are going to remain in inventory. So over time, our inventory is going to be at too low a number. We have to disclose the LIFO reserve, the difference between what our inventory is at LIFO and what it is at FIFO. If this were the first month of this company, the LIFO reserve would be the difference between $3,900 and $3,200, or $700. Disclosing that reserve allows analysts to figure out how much it would cost us to replace our inventory at today's prices, and allows analysts to compare us to other companies that use the FIFO method. Another problem with the LIFO method is, suppose we made a sale on January 18th. If we're in the perpetual inventory system, the last unit we bought would be at $11, not this $13. And if we sell just one unit out of this layer, then buy another layer on top of it, now we've got a layer with 199 units. And that creates kind of a bookkeeping nightmare. We could have many layers of inventory at different price levels. And that provides an opportunity for managers to sell through LIFO layers. So a new manager takes over this department and she says, you know what? If I don't replace these units at their higher prices, and I just let inventory go down to almost nothing, on our books it will look like we're selling these units at $10 each, so my gross profit will look better, my net income will look better, and I'll get a bonus. That's called selling through the LIFO layers, and if we do that, we're supposed to disclose it so investors know what's happening.